Good morning, everybody. This is Patrick MontesDeOcaTocker with the Equity Management Academy live trading room, live streaming from TicketTocker. We have some very exciting markets this morning with the gold market, starting with the gold market, basically up about 650 at 739.70 with a low of 1722.30. And this came down basically into the buy one and buy two level for the day that we have at 1725 roughly and 1716. The fact that the market came down into this level in blue and basically completed the previous pattern, met the target to the downside at the buy one to buy two level, and by reverting right back up above in closing above 1725, it activated a buy trigger after completing the previous bearish pattern, and we unfolded into a reversion that essentially met the target of 1740, which is the sell one level that we're looking at right now as it's being completed. The high so far that we have seen is 1744.80 for the gold market. For the silver market, we completed basically the targets of 25.20, which was the average price, and it came down to a low of 24.43, 24.44, which was below the buy two level that you see here at 24.79, 24.80, and found buyers, reverted right back up again through that 24.98, which was the buy one level, and completed the target of meeting the average price of 25.20. So we have a pretty amazing level of volatility, as you can see here. And this chart here is a perfect example of the mean reversion process that we look for, that we trade basically. What you see here is the market coming down to the extreme below the average price into the buy one level of 1724, 1725. It completed the target, did not quite come down to that 1722, which was the weekly buy one level that we're working for this whole week. And what you see here is what basically the AI recommends, the algorithm, when it has identified the area in blue. It's met the previous target, you might say, that was activated from that 1740-ish level. It tested twice the weekly average of 1738. By closing below it here on the 24th, it basically activated a bearish trend momentum that put into place the target of 1722. This is the weekly signal. And what you see on the left of the chart are the daily numbers that we used to integrate and aligned those numbers with the weekly, the monthly, the yearly, the cyclical patterns, and eventually identify what we call a harmonic alignment. And as you can see here, the price followed the energy of the market, activated a bearish momentum, got a lot of sellers to come in here, but coming down here met a solid floor of support, which is what the AI tells you. When you're down in blue area, ideally daily, weekly, or monthly, don't press the short side, because you're working against probabilities mathematically, and if you're measuring risk, you want to go with the probabilities on your side. So the probabilities are that, for example, the average price is 50-50 standard deviation, that it can go either way. And so here it went bearish, it activated bearish. When it does that, it activates the triggers below, the targets below automatically become activated. And if you're looking at the weekly signal here, the weekly average price activated the 1722 level. We did not quite come down to activate that level of that target, because we basically stopped at 1725, which is the daily number. When we are looking at the weekly, the daily numbers are obviously the short-term trading numbers that we use, particularly for day trading. If you guys are just day traders, just take a look at the daily numbers and see the AI, how I'm teaching you. If you come here every day, you can see that, and you can see my videos that we've been pretty much recommending our clients to buy into this correction, to buy into these levels in blue, because I believe that what we're looking at is a harmonic alignment of all of the major trends, from short-term to intermediate to long-term to cyclical trends, that at this price levels are indicating the probabilities are unfolding very, very high, that we could see the kind of capitulation that we saw today. I've been alerting my long-term traders that have a core position to be patient in trading this market long-term, because the price does not justify the fundamentals. There's a huge gap between the fundamentals and the price, the paper market. The gold mining shares, I believe, are at a fire sale. I'll say it again. I believe, and it is my opinion, that gold mining shares and silver mining shares are at a fire sale. And so, personally, what I'm using is the indicator, the VCPMI, to build a core position long-term, and use the short-term signals in the market to increase my liquidity, to hedge, to build some kind of a long-term core position that I believe is going to eventually reflect the real fundamentals that we're dealing with. I think one of the reasons why we saw this early sell-off here this morning was that unemployment numbers showed less than 700, I believe, around 683 filed for unemployment, which is on the low end of what the expectations were. The jobless claims fell by more than expected last week to 684,000 as business restrictions ease. So, are we done with the pandemic? Are we moving into a strong economy? I think it's a little bit too premature still, because there are still some pockets of risk, not only here in the United States, but on a global basis, particularly Germany, Italy. There have been, I think, another spike, and it's a fourth spike. And I think we're moving into some serious numbers that are going to indicate a devastating world economy is not showing any indications at all of going back into some kind of normality. And what we're going to begin to see is the pressure being put on a lot of this government bonds, sovereign bonds, foreign bonds, that are going to begin to increase in interest rates, putting even more pressure to the world debt. And so I think we're moving towards the Fed's probably one of the last few tools that they have to manage this is in order to eliminate the risk of interest rates accelerating, which would be devastating for the economy, for the world economy. I think yield curve control is becoming more possible, more prominent. And I think the markets, particularly gold and silver, are very sensitive to this, because if we begin to discount, basically the markets discount the possibility that the Feds can implement yield curve control, this could be explosive for precious metals. I'm just cleaning some of this markets here, and why would the Feds controlling the yield curve would be bullish for the metals? Well, I think what the Feds have been saying, and what Chairman Powell has been saying, is that they want to allow for inflation to run to its course, or not to control inflation. And I'm not sure if they really have the control, because if you look at the 10-year note, it spiked to 175 on just anticipation of what the Feds are doing right now is inflationary. In the long term, it's very, very inflationary. Creating money out of thin air weakens the currency, weakens the purchasing power of the U.S. dollar, and any asset in U.S. dollars is at risk in terms of its purchasing power. Not only here in the United States, but most currencies around the world are moving to zero, basically, as they continue to print more fiat currency into a currency that is not supported by any natural resource, gold, silver, or gold standard, or a basket of other currencies that essentially would reduce the risk of losing its purchasing power, which is really what we're talking about. So the focus has become the U.S. dollar. What is this going to do to the U.S. dollar? And I think the markets, particularly if we do get this yield curve control, it essentially means that the Feds are going to allow for the dollar to devalue by capping interest rates. The dollar would literally collapse. It has no support mechanism, such as interest rates. And so my feeling, my friends, is that we are moving and we are accelerating into devaluing world currencies to zero so that we can devalue the debt in its currency with it. I think we have to take a look at how some of these third world countries have dealt with their debt problems, like Argentina, Brazil, Mexico. I make a point of using Mexico in 1981 simply because I was part of that process, that the Mexican government, with this huge, tremendous debt to the U.S., was not able to pay even the interest on the debt. And so instead of diversifying the currency into a basket of currencies in order to diversify the risk of the interest payments, they decided to devalue the currency. And literally overnight, the Mexican peso went from 16 to 50, 60, and it went to thousands after that because the economy went into hyperinflation. And that debt interest payment was reduced to literally zero. There are very few alternatives to manage this tremendous global debt that we already had coming into the pandemic. Never mind now that we're looking at, $30 trillion in debt, which has been spent, pretty much, I think, more than any other time in the history of the markets, particularly in the last 10 years. So we are spending $30 trillion to manage a $20 trillion economy. It just doesn't make sense. The system is upside down. The monetary system is upside down. And this is one of the reasons why I am suggesting my traders, my subscribers, that read my reports in the Associated Press and Seeking Alpha, that I think this is a serious change in the paradigm of the monetary system. And the US dollar is really at risk of imploding and causing massive inflation in the US. Shadowstats.com provides analysis in the market, analyzing the old formula that was used in the CPI, the Consumer Price Index, which included food and energy prices. And if we were to use the same measurement that we used back into the 70s, you're looking at inflation running at about 8-9% already. So there's a huge anomaly between the numbers that the government publishes with regards to inflation to keep it under 2%, because they feel that energy and food prices spikes are temporary. Again, if we use the old table of measurements, it doesn't apply to where we are right now. This is uncharted waters, ladies and gentlemen, and using old information in an economy that did not experience pandemic damage is, to me, a waste of time. I want to look at what the market is saying now, because nobody really knows fundamentally, what happened or where we are. They're still trying to dig in, figure out where. Let's put in another 1.9 billion in stimulus, and we already have about $15 trillion roughly that has been put into stimulus. So how much more is the system going to require to form some kind of balance in the monetary system? What is real money now is that question. And I'll tell you, real money is not fiat paper money. If you factor in the current inflation rate that we're running, you're losing in cash. And I'm looking at this same situation for myself, and I'm saying, wait a minute, it doesn't make any sense. If I leave cash in the bank and we're looking at a real inflation rate of about 8-9%, I'm going to be losing, for every $100,000 deposit, about $9,000 a year in inflation, purchasing power. Most people don't realize that, obviously, because the balances continue to show $100,000. But you go and try to buy that now, something, it's going to be more expensive, as you see happening in the food sector, as you see happening in most of the supply chain. Products have been broken. Plastics, chips, computer chips, physical gold, silver. The durable goods number that came out this week was showing basically that the supply chain is broken. It was down to minus 1.1%. It was expected a plus 0.4%. Most of that essentially is in a shortage of supplies. So I really want to kind of focus on the fact that my feeling, based on what I believe we're looking at, is that there's a tremendous need to go back into the economy. Obviously, I'm tired of this whole thing myself. We've been in this lockdown, more or less, mode for about a year or so, obviously, a little over a year. And so we're dealing with a reality that we have to deal with, because if we don't, this is going to cause massive long-term damage in the system. And I have a real difficult time listening to all these pundits that are claiming great economic recovery. If you're looking from the bottom of the barrel of just what happened, obviously, it's a different story than prior pandemic levels. So how all of this is going to weather the markets, you might say, or how I'm using it, I don't think that, again, if you take a look at what is money right now, which is what we're looking at, what is real money? Is it the US dollar fiat currency, or is it gold or silver? I believe that we are moving truly into levels of volatility, particularly in precious metals, that we have never seen before. The Reddit warning, so to speak, was just the beginning of things to come in terms of volatility, particularly for the silver market. And why is that? Well, when I took a look at the 9-year cycles in the silver market, To me, it is one of the most bullish positions silver has been. And when you take a look at the fundamentals, and you take a look at the cash market, and you take a look at the paper market, silver at $25 an ounce is offering us, you guys, the opportunity to convert fiat currency into real money. Not Bitcoin, not virtual currencies, which are tradable assets, the tradable instruments. But real money. Real money. And real money is gold and silver. Now, just to point out a couple of things here, if you're looking into the cash market and buying and actually taking physical silver, you're looking at premiums that are 30, 40% with a long-term timing, waiting period before you get the delivery. And so the premiums in buying real money has become pretty expensive for most of us. When, the premiums usually were maybe 10%, 10, 15%, you're looking at 40% increases in obtaining actual physical silver. So the only place that we have to trade these markets is basically in the paper markets. And so right now, we have, again, coming back here to the markets, an anomaly that I believe is going to be adjusted any day. You can see here today the price coming down into these levels caused this incredible reversion unfolding, which really is something that we want to take a look at and analyze what really happened here. And the algorithm, the AI, this is what's incredible about this algorithm is, all the way through here, I've been saying, pretty much that if we could come down here, this is just interpreting the algorithm. We're going to activate a bearish trend, but you don't want to sell into this, particularly even if it came down into this blue level. Yeah, because this is what the AI expects. This is a classic reversion to the mean from the extreme below the mean of buy one after it identified buyers, which is what it's supposed to do down here, and bingo. Not only did it activate, a buy signal from the day, but it met the target of the mean and the sell one level of 1740. And then it went into an area, again, that we identify as distribution of supply. Expect sellers to come in, supply to come in, and boom, that's exactly what happens. We're back down to the mean. And this is now the weekly signal of 1738 that went into the 1740 daily targets and activated the 1747. So right now, the market is coming back down below the average price, and we recommended our traders here to take profits on this trade. Short-term day trading, 1725 to 1740 was a great trade. And we post very actively our traders in our live trading room pretty much 23 hours a day. And here we went long at 2480, aggressive long 2483, use max stop, and we gave a target of 2498, 2521 daily mean target on silver. On gold, it went about 1725.1 was the entry point. We give you a stop level. You know, we pretty much structure the trade. And I pretty much share with you what I'm doing, you know, using a trailing stop and pretty much meeting the targets. 1744, 2510, and we got out of those trades. So we use the volatility of the market short term to really benefit by this I believe just short-term incredible buying opportunities that the market is providing right now. So let's watch the action here from the mean a little bit here throughout the day, but I'm pretty comfortable where we are here for the day. We took some profits out this morning. We're holding on to our core position. And let's see what the market does here throughout the day, and we'll continue to update you here. What we want to see is the market, you know, pretty much trading about 2561, which is above the sell to level of resistance that would make that a support area. 4480 is the high so far, 2525 in silver. I'm sorry. I think let me take a look at silver here. $25.21 was the average, and you can see on silver from $24.98, even the buy two level of $24.80 activated a reversion. This is a classic reversion from the extreme level of the daily, and it was completely oversold, and it is still oversold. It's trading under the weekly of 25.36, and so 25.39 to 25.36 is my magnet price for today as we show this reversion unfolding in silver. Bitcoin is into a corrective mode. 40.40 here was the low made earlier here, and it's trading below the weekly average, which has activated 38.75, but it is extremely oversold on the daily. You see more clearly here on the daily chart. So we'll see how the market reacts into this 38.75 level and see if it holds. But you're looking at the market coming down into that blue zone between 38.75 and 33.69. Volatility. This is what you call volatility. And, this is trading right now in between the averages weekly and the averages daily of 1731. So this is where we do nothing. We already took out our trade for the day here. And I'm waiting to let the market identify the next highest probable trade. I'm watching copper very closely here. It's come down to under $4, and it's in the accumulation of supply area. So if we get a close above the buy one level of 399, $4 again, that's going to be very, very supportive for copper. I think most of these metals here, including platinum, palladium, went into a bit of a correction. And I think you want to buy into that correction in precious metals. As frustrating as it is for most of us longs, this is an incredible opportunity to add, to recalibrate, to adjust. And as we complete this here, I believe that we're looking at potentially the bottom cycle of the next leg up for the next 30 days. We track the 30-day cycles, the 360-day cycles, the 90-day cycles as well, in addition to the VCPMI indicators. And I tell you, it has been challenging. It has been challenging to, again, adjust to the anomaly, you might say, that we have between the cash market and the paper market here. But as we continue to see this cash shortage, or the physical availability of metals, gold and silver, continue to decline, as the world awareness continues to increase. And it's very difficult to get physical gold delivery. Obviously, the paper markets are the only alternative, which is what we see in the COMEX delivery notices, that more than any other time, and you can check this out yourself and just Google COMEX deliveries. A lot of this stuff that I talk about is easy enough to verify by simply Googling it. And what I'm sharing here is basically the same information, how I'm using it to monetize and how I'm using it to trade the market. It's been a challenging year since the beginning of the year. If you did not, obviously took advantage of the Reddit short-term bleep, so to speak, we've been in a consolidation, that is, I think, beginning to frustrate the long side of the market, which is really what we want to see. We want to see the capitulation of the sentiment give up and create a, you might say, bearish sentiment down here that potentially is the capitulation. And if the longs give up and you get sentiment, bearish sentiment here, all these gurus that are, publishing all this stuff, all this data and all of this videos that are being published on the internet with this short quiz titled, you might say, are experiencing a loss of credibility, in my opinion. What I'm doing here is basically taking that same information and trading it and showing you how I am using that information and listening to what the market is saying and applying the variable change in price momentum indicator as my guiding tool when I want to go trading. As I say, it's like a GPS for your driving. In this case, you go trading. And depending upon your ability to interpret the VCPMI and follow the instructions and the discipline, it provides for you an incredible objective way of looking at the market mathematically. It's not a perfect science, it's not a crystal ball, but it is a probability, mathematical probability, that allows you to look at the market completely objective from a non-emotional perspective. Let me just work on this for a little bit here. And what we're looking at here is pretty much the trend line support from the high of 1754 that we made on the 17th. And so I'm trying to identify the levels, confirming the levels that validate, you might say, the VCPMI, the trend direction. But this was a significant move today. Obviously, a little bit of profit taking came in, and now the market is adjusting, you might say, to this move and trading in between the averages. Things quiet down quite a bit down here. The 10-year note is trading at 159.6. So rates are, under 160, which should be very supportive for precious metals. Pretty precise structure when you really take a look at the trades that were done today. Activating a buy from B2, completing the target above 98, and the average daily of 25.21, and obviously when neutral at the average, which is what we suggest when you complete the target to do. So now we're waiting again, and it's in this bearish mode between the buy one and the average price daily. It's under the B2, which is pretty much showing the market is oversold. And this is how the AI tells you to follow, the market and trade the market. For what the market is doing, not what the fundamentals expectations, should make the market do certain things. You got to trade the market separate from the fundamentals, although the fundamentals in the big picture and the macro picture do take major importance, but trading the market is different than analyzing the market. What we do here, live streaming here in TikToker, is trade that information in real time. Show you how we use that information, those fundamentals, and pretty much how I apply it in this room in trading silver and gold. I think the question that we want to ask ourselves so far is the low that we saw today in silver and gold, is this going to be the final low? Is this the final capitulation? And I'll tell you, to answer that question from a completely technical point of view, the VCPMI long-term cycles are anticipating that we're coming down into the completion of this short-term cycles, this bearish patterns by the end of this week. we expect that as we come into next week, we're going to be unfolding the upswing of the reversion to the mean that can potentially bring the market up to 1,820 roughly. But we have to get through some resistance, and that resistance in gold is at around 1774 in that vicinity, and it keeps coming down lower and lower. Now we're looking at let me take a look at gold here. $17.38 is the weekly, and the major breakout point, I think, is the 1775, 1780, which would break out of all of this daily, weekly, monthlies patterns. And closing above 1780 breaks out of this channel that we have, which is the descending wedge trend line resistance. And from up here, basically, there's nothing all the way up to 1837. So we have to get through this resistance, this supply here. And once we get through this supply and we take out the 1775, I think we're going to be off to the races into that 1800 handle once again. In silver, what you're looking at is the market coming down almost into this trend line support or wedge support. Let me see what the adjustment here on the fan lines will do. If we're looking at today's low as the bottom of this correction, then yeah, you're looking at confirming the fan line. The Fibonacci fan lines are confirming the resistance is all the way up to 28 on silver. And I got to tell you, this here looks pretty good to me for a potential key reversal week unfolding, a key reversal day signal unfolding, making a lower low, reverting from there, closing above, ideally into a plus, classifies that as a key reversal signal. So I am looking for key reversal signals because I think the market is prone now to see reversions unfolding from here. That's what the algorithm is telling us. Look for reversions to unfold from these levels here. But we do have to get through some resistance. We do have to get through some supply. But I am confident that as we move into the end of this cycle, we are going to see more buyers show up, more buyers come into the market. We got a little bit of resistance up here, obviously. So closing above 1738 is going to activate the weekly bullish trend momentum. And then we're looking at the targets here, 1740 to 1747. And once again, from the activity that we saw here earlier, this was a fabulous reversion. Basically, this is a classic example of mean reversion trading today. Once again, ladies and gentlemen, thank you for the pleasure to spend this time with you, sharing this incredible information with you that truly has changed my life. And I hope as you come here every day, it changes yours. You take care. I'll talk to you soon. Be well.
The risk of loss in trading commodity interests can be substantial. You should therefore carefully consider whether such trading is suitable for you in light of your financial condition, and considering whether to trade or to authorize someone else to trade for you. Past performance is not necessarily indicative of future results.